Hi there, welcome to this latest video. In this video, I look at Escape Hunt's latest trading update and I break it down and explain why I think it's very, very positive. Let's get into it. The content of this video does not constitute investment advice. Do your own research. If you do invest in anything mentioned in this video without doing your own research and the share price goes down, you only have yourself to blame. However, if the share price goes up and you want to give me some credit, I'm happy with that. Escape Hunt, ticker ESC, if you need to know that. Trading, this is a trading update they released, trading since the reopening of its UK sites for 6 months to June 2021. And what I'll do is go through the RNS, then I'll break it down and tell you what I think and why I think it's positive, okay? So let's look in the 10 weeks to the 25th of July. Of course, most of the sites, wasn't open for the entire year because of COVID. But they say trading has been encouraging, with levels of occupancy returning faster than expected. Good start. Revenue and site-level EBITDA from the UK owner-operated sites has been ahead of management expectations, getting better. Total revenue was 58% higher than the same 10-week period in 2019. Very good. Revenue from the 8 established UK sites, which were open in the same period in 2019, was at 95% of the levels in the same period in that year. So they're almost back. I mean, when you think about it, they reopened back in, May 17? May 17. There were still restrictions till August 19, but people have come back straight away. They're almost at 95% on those like-for-like sort of sites, almost back to where they were when they shut. When you think about it, the worry, the environment about COVID and pandemic and all that stuff, that's amazing. It's gone straight back to where they were pretty much. But it gets better than this. The company is benefiting from various initiatives implemented during 2020 to improve site-level margins. Always good to improve margins. Also, they benefited from a temporary reduced VAT rate expected to run until 30th of December. That's temporary, but, we'll take that. It's fine. As a result, estimated EBITDA at site level showed a 185% increase over the same 10 weeks in 2019. That's big, okay? On a like-for-like basis, that's what you look at, like-for-like, so you can do a direct comparison. Site-level EBITDA, earnings before interest, tax, depreciation, amortization, from the company's 8 established sites, increased by 83%. So even like-for-like, it's up by 83%. And that's because the margins, of course, and there's a bit of that VAT as well, but the margins, very important, that will stay with them. The VAT thing will end in September, but they've improved their margins. They've said this all along. So it's very good. And it gets better. I haven't started yet. So the last 5 weeks, occupancy has continued to grow week on week. Like for like, which is very important in performance, has further improved with sales from these original sites exceeding now sales in the same period in 2019 by 2%. That's phenomenal. In the last 5 weeks, so that was even before restrictions were fully lifted, when they could only allow 6 people in a room. Now they can have 8, I think, maximum. So it's now they are doing more revenue than going back to 2019, pre-pandemic. So that's very encouraging. Straight away, demand. They've got that growth. You need that. EBITDA improved by 114%, and that's like for like, 114% improvement. That's good. Cash, not a problem, 2.4 million. They've also got a convertible loan note. If they want to use it, it's not been used yet and remains undrawn, but it's there in case they want to grow faster, acquire more sites. They do that. So let's reiterate, all the group's UK owner-operated sites were closed from the beginning of the year, only reopening on the 17th of May. Okay? Unbelievable. So 5.5 months they're shut for. Unaudited group revenue for H1, when you realise it, they've been pretty much shut, expected to be 1.1 million. Really? They've hardly been open. So this is 900 grand from owner-operated sites and 200 grand from franchisees' revenue. And of course, the franchisees have suffered. The entire world has suffered due to the pandemic. So a lot of them have been shut as well. But further progress has been made on the group's UK rollout. Remember, they are heading towards a target of 50 sites in the UK, or owner-operated sites. Maybe not all in the UK. There's one in Dubai, of course, in Paris and Brussels. But they're going for 50 sites. The new site in Milton Keynes, contracts exchanged, 18th owner-operated venue. That's good news. At the group's proposed 19th site at Lakeside, a huge shopping centre. I think they get over 20 million in footfall through there a year. where games have been delivered and in the progress of being installed. All right, so that's not far off. So we can say here, Milton Keynes and Lakeside, just a matter of weeks, maybe a month or so before they're both up and running. Okay, further potential sites are in the pipeline. Nice, and the board believes property conditions will continue to be favourable in the short to medium term. I've said this several times, and I covered this in a previous video about now. Commercial retail landlords are desperate, for tenants. They're calling up, decent companies saying, "Do you want to take sites?" Now, pre-pandemic, Escapement probably couldn't afford to be in Lakeside or places like that. Now they can, and in fact, now commercial landlords are saying, "Please come. We'll give you some money. We'll do anything you want. Well, favourable terms." So they say it's favourable in the short to medium term, which is good. All right. I don't know if they're offering them money. I don't know what the incentives are, but they say it's favourable. But now they can get in those sites. As a result, the board remains confident of achieving the target of 20 owner-operated sites ahead of the original target date of June 2022. So this is my breakdown here, okay? So 1.1 of revenue in 44 days of trading, 900 grand from 14 UK sites. So 900,000 divided by 44 days, that's all it was. That's all the trading days they've had this year, up to this update. 44 days. That is 20 grand, say, per day. I'll round it down in 20 grand. It's 20 grand, 500. 20 divided by 14 sites, it's 1,428 per day, okay? This is about 10,220 per site per week. Again, let's round it down. Let's be conservative. Round it down 10k, okay? This equates to each site generating revenue of 515 per year. This is 15k above forecast already. Already. And remember, this is only up to the 30th of June. In the last 5 weeks, this is after 30th of June, occupancy has continued to grow week on week. Like-for-like sales is exceeding sales in 2019. So you can safely say that target there, which the brokers had down, of 500,000 per site, is now, they're exceeding that. They're doing better than that. There's more people coming in. So this is very good news. So sites are getting busier, and the longer they're open for, the better they're getting. They're more busier, and more recognition, brand recognition. People are walking past them in these high footfall centres saying, "Oh, what is that? We should try that." When I went to the one in Basingstoke, by the way, we were sitting there for 5-10 minutes, and several people just walked to the front asking to book. They couldn't book, so they booked out, so they booked the next available session. And so it was just the footfall in these busy high, shopping centres. People want leisure. They want to do something, So, people want a new kind of leisure, a bit of variety. They've done bowling, they've done paintballing, which I found dreadful. Bowling gets boring. There are 6 different games in each room. I've had people say this to me. When you get boring, though, when you know the answers, there's 6 different games in each room. With bowling, it's one game. I get the same score every time, pretty much. I'm rubbish. But I still go and play it. It's just when you have friends come around or something, or you want to do something, you look for options, If you haven't done something before, you give it a try. And I just genuinely think escape rooms are more exciting and better than paintballing or bowling. What else is there? I mean, so, I said entertainment is getting bigger. Leisure is getting bigger. So it's very encouraging. So let's go back up to the 30th of June. That's 20k divided by 14 is 1,400 per site. Okay, so for the remaining 180 days of 2021, assuming they only have 14 sites for the rest of 2021, which is highly unlikely, because as we've seen, Milton Keynes and Lakeside are about to come online. That would mean H1 is 1.1, H2 3.6 million. That's 4.7 million for the year. They haven't been open most of the year. I say so far most of the year. 5.5 months of the year, they haven't open. So that's only based on 14 sites being open since May. If Milton Keynes opens by September, that's another 117 weeks at 10 grand, 170k, okay? So that would mean the figures for this year would be 1.1 plus 3.377, 4.87. Right? Now, we can simply say, if you read the financial results, they even say that Lakeside will be open by the 4th quarter, which is the busy quarter, which is when people start booking, of course, for Christmas parties, corporate dues, all that stuff, and just tend to get out a bit more and want to do stuff. And, of course, the weather in Britain is not the best in the winter. So when people are looking to do leisure, where do you think they want to do it? on a drenched, wind-swept golf course, or on a Segway out in the wilds getting muddy and dirty, or paintballing, or in the nice, cosy, warm shopping centre where you can go for food, my wife can go shopping, all that stuff, take the kids in the escape room. So if Lakeside opens by October, that's another 13 weeks, 10K. That's 130K, okay? So let's say, if I completely believe they'll get these 2 sites open, maybe more, who even knows, but let's go with 2 sites. That's 5 million this year, okay? 5 million this year when they've been shut for most of the year. So let's go with full year 2020. This is based on 20 sites. 20 times 10 per week, 50 weeks. That's 10 million. Okay? 10 million would mean a 104% increase on 2019 when all sites were open. This is conservative, as they're likely to have 20 sites before 2021 and more than 20 sites by the end of 2022, I believe, because their target, they said they'd get ahead of that anyway. So I think they'll have more than 20 sites by the end of 2022. So I think this is conservative. And remember, this does not include virtual games. Play at home, outdoor, these digital games, these corporate games they're doing, we can do it remotely, digitally. It started taking off. They launched it during the pandemic. They're doing very well. Doesn't include franchisees. The rest of the world will be opening up. As soon as their vaccination programs catch up, they'll be opening up. And already in America, they're starting to open them up, and it conducted trials there and open days there. Other products, economies of scale, which is huge. When you get bigger, of course, the financial sort of burden of opening another site becomes less because you're generating more revenue. And there's many things like that. I mean, as you get economies of scale, you maybe advertise more. You become a market leader, and that's when you are afforded a higher multiple, basically, than any other competitor, because you are the big dog. So current enterprise value is there's my son there asking for I don't want that, Fred, a request for a game. Current enterprise value is 31.46 million. Take off the cash, 29.06, right? That's enterprise value. That is less than 2.9 sales, forecasted sales for the year. Okay, less than that. It's my son again asking for a game thing. That is not expensive. This is cheap. You look on AIM and some of the stocks, they've got no revenue, and they're valued on like 100 times no revenue, if that's possible. Or you could regularly look on AIM and see companies valued at 10, 20 times revenue, and people are hyping it up. They're valued on, literally, because this year wasn't a proper year, 3 times forecasted revenue for next year. This is cheap for a fast-growing premium brand. They've got to sign up with Doctor Who. That is the BBC's Jewel in the Crown. They don't give that to anyone, or share that out with anyone. They're very serious about their brand. Only premium brands can align with Doctor Who. They are 5-star rated on TripAdvisor. Look at this. Birmingham, 1,500 reviews, 5 stars. Manchester, 1,000. Escape Hunt in Liverpool is 762. Leeds, 1,100. Bristol, 1,200. All 5-star reviews. Oxford, close to 1,000. Escape Hunt Reading, 644. Edinburgh, 668. Norwich, these are newish ones now, newish sites coming on. Anyway, 5-star reviews, 291. Escape Hunt Resorts World, 277. Basingstoke, the one I went to, new, only opened back in November, I think it was, and was shut then for like 6 months. 131. These are brand new ones. At Cheltenham, pretty much 114 reviews, and these are the newest of all. Kingston, 52, 5-star, and Escape from Watford, 61. So every single one, 5-star reviews. So first of all, the product is right. People are liking it. There's demand there. They're in premium locations. These high footfall centres. I've been to sort of escape from the road there. It's on a little sort of industrial estate. You feel a bit, dodgy going in there, really. But these are not. They've got nice little seated areas outside. You can have some drinks, some nibbles. And so it's a nice environment. Like I said, there's lots of other... In these places, there are lots of other things you can do as well, leisure-wise, Like you can eat there, cinemas, all that stuff. So it's in the right area. They are a market leader. They have all these sites so far. Dubai as well, Brussels, Paris. Soon to be profitable. It's 16, 17 sites. They are EBITDA positive. My forecast of this, okay, 5 million this year. That's on the 16 sites. Of course, Milton Keynes opening before September, and Lakeside opening before October. Next year, I think they'll be doing this because adding digital, adding franchisees as well. Now, it's 112% growth, of course, but it's not like for like because they're shut for half the year. That's EBITDA margin, I believe, will go up as they get busier. So it starts off with 30%, that's their margin there, and they're heading towards 40 there as time goes on, as less capex happens, and basically get busier, on a point of view. I put them on a EBITDA of 20. So right now, they're just below the 7%. This was yesterday, the day before, when the share price got up today. But 140% increase on current valuation. Okay. In 2023, 241%. That's with 14,000 in revenue there, and 4.7 EBITDA times 20. 2024, 347%. 2025, 465%, and with 49 sites, 591% increase on current valuation. And this valuation does not include. I said that. No, that wasn't. I'm assuming they are going to be doing exceeding operations. So this does not include virtual games, play at home, outdoor, franchisees, other products, economies of scale, market leader premium. 5 reasons why I think this is good risk reward. Okay, 1, they have a premium proven product. They can easily now. These are modular games. They can replicate it both geographically and economically. It's cut and paste. It's cookie cutter sort of thing. Just replicate them. So that's easy. They can do that. It's a proven product. There's very good demand for this product. All they have to do is acquire more good sites, and the demand is there. It's high footfall destinations. It's walk in, demand is there. All they got to do is open a site in these areas. Acquiring good sites comes on very, very favourable terms due to the pandemic, as we've seen. They are a market leader in a new growing sector, and this leader status will improve their economics. Leisure is a growing sector. This is a new sector within that, and they are the market leader. Okay, so essentially every site they acquire is a step up in their valuation, and the more mature the sites, the better it performs, and they're having no problems gaining good sites. Then once they get to 50 sites, it doesn't stop there, because if they decide to stop or slow down the rollout of their own operated sites, then capex just drops off a cliff. So big margins, cash flow goes up, absolutely, and then they can keep adding franchisees at very little cost or next to no cost, and then it'll still be meaningful to the top line and the bottom line. Then hope that helps. Thank you for watching the video. I hope you enjoyed it. If you did, give it a thumbs up. If you want the next one to your inbox, hit that subscribe and notification bell, okay? And if you want to leave a comment, then please do it in the Sharepickers Investment Club Discord group. I'm not very good at comments on YouTube. It's too many social networks, So now, the Sharepickers Investment Club, we have our own chat forum, and we chat about a lot. There's a collective, huge amount of knowledge and resource right there. So why not join? Sharepickers.com. Speak soon.